Hey everybody, welcome back to Actual Investing. Now, if you're familiar with the ARK Innovation ETF, or if you've been invested in the ARK Innovation ETF, you probably know that it has not performed terribly well in recent years. If you look at the past 5-year price action of the fund is pretty much flat over the past 5 years while the market has been going up, up, up. And this is even after an amazing year in 2020 for the fund. What the hell is going on at ARK, and what is going on with this massive underperformance? Let's take a look. So let's start with the fund itself. ARKK is the ARK Innovation ETF managed by the legendary Cathie Wood. Now, love her or hate her, she is the most successful thematic fund manager just due to the amount of assets under management that she's been able to compile. And the fund does charge an expense ratio of 75 basis points, as we say in the industry. That's just 0.75% per year. Now, if you've owned the ARK Innovation ETF and you're thinking, well, I've never had any money taken from my account for ARK Invest, that's because this is an expense ratio that's taken in daily arrears from the performance of the fund. So that means you don't actually notice the money disappearing. It's just reflected in the fund's performance every single day that you hold it. All right, enough about that. Why has the fund underperformed over the past 5 years? This is an ETF that's focused on technology. They're investing in big themes like AI and genomics, both of which are really hot topics lately. So why has the fund underperformed? Well, I think to understand that, we need to look at the holdings of the fund. Now, this is a website called Cathie's ARK, which isn't actually associated with Cathie Wood or ARK Invest, but it does a really great job of tracking the holdings in the ARK Innovation ETF as well as the trades that they make. So I think this underperformance boils down to a couple things. One, Cathie Wood and ARK Invest have picked winners. Tesla and Coinbase have both done extremely well for the fund, especially Coinbase that's up over 300% in the past year alone. Now, Cathie was buying the dip on Coinbase when it was in the double digits for share price. However, she also bought at the IPO, so I think this may have evened out. But when we look past those two winners, we see a lot of speculative, unprofitable names like Roku, Roblox, CRISPR Therapeutics, Unity Software, Teladoc Health, Ginkgo Bioworks, and more. So why did these kind of stocks do so well in 2020 and they're not doing very well now? I think a lot of it boils down to interest rates. So you've probably heard this said many, many times, but interest rates in the United States rose more rapidly than they've ever risen in recent history. And what happens when interest rates go up? And with unprofitable growth stocks, investors typically value them based on their future earnings, right? Because they don't actually have any earnings today. So you have to kind of look forward and see what kind of earnings they have the potential to make in the future. However, when interest rates go up, these types of stocks become more risky because they're often cash-burning machines, so they need capital. And when interest rates are high, it's really difficult for companies to get more capital, to borrow. And this can lead to a lot of things. It can lead to bankruptcy at the worst, and it can also lead to dilution, where a company sells their own shares, diluting their shareholders to raise cash in hard times. It can also mean taking on high interest rate debt. None of these things are good. So unprofitable stocks and small caps just have not done well recently because of these economic conditions. So let's take a look at 3 of these stocks in the fund that are unprofitable, that are hitting all-time lows, and see if they're a value trap or if they may be a hidden gem that might be poised to bounce back. So let's look first at Unity. So Unity Software is a stock that I've covered on my channel before, unfortunately. It is a stock that I used to own. I do not own Unity now. However, Unity is now looking quite cheap if you look at some basic metrics that are used to value software as a service companies. Unity on a price to sales basis is quite cheap. However, all is not right in the world with Unity software. So let's take a look at their financials first of all. This is Google Finance, and we can see that their revenue is no longer growing year over year, and their losses are still continuing. They had net income of negative 300 million last quarter with revenue of 460 million. So they spent 300 million to make 460 million. That doesn't sound like a very good business, does it? So what's going on at Unity? Well, Unity is a software platform for video game developers. Now, they've also been trying to get into other niches, such as the industrial sector. However, it's mostly just used for video games right now. They have a massive share of the mobile gaming market. The other nice thing is that they have some implications in AR and VR, so Unity software is actually being used for Apple Vision Pro headsets. But the company itself is going through a bit of a pivot. So this is their most recent shareholder letter, which it's kind of nice that they make shareholder letters. I kind of like that. Makes it very easy to digest what's going on each quarter at the company. But what we see is that they're talking about this strategic portfolio. Revenue from our strategic portfolio was up 2% year over year, but revenue for their whole company was down 8% year over year. So what's going on? What is this strategic portfolio? Well, a couple quarters ago, Unity decided to stop reporting on certain business segments and divest those business segments, and is now focusing on what they call their strategic portfolio, which are the business segments that they believe have the potential to become the most profitable business segments. Things like Create and Grow. So these are their video game platform, obviously what they're known for, and their advertising platform, which they've expanded lately with their bolt-on acquisition of IronSource, an ad tech company. So what caused this restructuring? Well, it was a few things. For one, Unity stopped growing organically. So when you are a growth company, the most important thing that matters, besides like we talked about interest rates, the most important thing besides that matters is your revenue growth. If you're growing revenues year over year, that tells the market that you have a product that people want and that is gaining popularity, gaining market share, and in the future, you're gonna have the potential for even more profits because of economies of scale. So when Unity stopped growing, their stock price stopped growing too. So if we go back to their financials, we saw Unity having this amazing growth in 2023, 57% revenue growth. That was all through acquisition. So they acquired this company, IronSource, and that's what spurred their revenue growth. None of this was actual organic revenue growth of Unity's platform. Unity's organic revenue growth was actually flat. So maybe this acquisition was just a well-timed acquisition to make things look better for investors, when in reality, investors are wising up to what's really going on. Unity is just no longer capturing market share. And part of it has to do with some controversy that occurred with the company. A few quarters ago, they actually kicked out their CEO because of some, I would call them money-grabbing decisions that he made. He essentially revamped the company's whole fee structure, which upset people who had already agreed to the previous fee structure, and there were some things that he may have overlooked that could have really screwed over some smaller creators. So, long story short, Unity has a lot of turmoil in their business right now. They're no longer growing. They're trying to pivot and focus on their strategic portfolio, but they're still generating these massive losses. I don't see how Unity is going to turn this around. So you can look at the stock price and think, wow, Unity is down 76% over the past 5 years. It must be a bargain. But when you really look at the business, this is not the business that we were promised back in 2020 when the company was growing and when AR was supposed to take over and when the metaverse was going to be huge. Those type of things really sent the stock soaring. But Unity doesn't have any of that going for it right now. So with the company that is still operating at a massive loss with no growth, I am just not bullish on Unity anymore. And I did sell my Unity shares quite a while ago. All right, with that sobering analysis done, let's look at Teladoc Health, which is conveniently at a nice round figure of $10 a share. I have a very embarrassing story for you guys. When I was early on in my investing career, purchased shares of Teladoc Health at $296 a share. Yeah, I did that. That's really embarrassing. And I lost pretty much all that money. And I just want to share that with you guys so that you know that I am human and that I have made all of the investing mistakes in the book and I've learned from them. And that's why I have this channel now. And, as I continue my career in finance, I'm learning from my mistakes and I realize what went wrong. So yeah, I was the idiot who bought Teladoc at the peak. You can laugh at me in the comments below. So Teladoc, we can see, has just flatlined and is just slowly bleeding over the past few years. What is going on with this company? Because Teladoc is huge. I have friends that use Teladoc. Companies partner with Teladoc to give their employees access to doctors without having to go in to the physical doctor's office. It seems like a really intuitive product for most people to have. So why is their share price doing so shitty? Well, I think this says it all. Teladoc is not growing. Look at this. Quarter over quarter revenue growth is non-existent and they're still making losses. So if your company's not growing, it should be at least turning a profit. And if it's not turning a profit, it should be at least growing. Teladoc's doing neither of those things. They're not growing, they're not turning a profit. It's exactly what we saw with Unity. It's the same kind of thing. Teladoc is operating at a loss with no revenue growth, which means they've tapped out their market share, and for whatever reason, they are not able to make profits. Now, Teladoc does have a lot of expenses, especially SG&A, which is advertising. This is a business that relies heavily on advertising and staffing, and I just don't see a turnaround for these losses. If you look at their latest earnings release, things don't look any better. Revenue grew 3% year over year. That's just barely keeping up with inflation. The company's still operating at a net loss. And even though they do have positive cash flow from operations of $9 million, the market is still unhappy because if we look at their outlook, revenue for the next quarter is expected to be $635 to $660 million. Well, this past quarter, they just had $646 million. So that equates to negative or barely positive growth. So this is just not a very clear range. It doesn't point to any growth. And BetterHelp, which was their star grower, is now shrinking. So Teladoc just has so much promise and so much potential. They have these great margins. They have this service that everybody knows about. They have BetterHelp, where you see the Gen Z and millennial generations really liking, because you don't have to go in and get therapy in person. You can match with the perfect person. It's not generating any cash. It's just not a business that is looking like it has a bright future right now. So sure, Teladoc shares might seem cheap at $10 a share versus the $296 that I bought them for. Oh man, I cringe at that. However, when we look at the business, I see no redeeming qualities at this point. Okay, maybe this third stock can save us. Roku. I think if you're in the US, you likely have heard of Roku. So Roku at the heart is a streaming business. They're a bit of an ad tech company because the way they make money is through ads. They actually sell their Roku products at a loss and make up for it with advertising. So it's a nice little business model. But when we zoom out on Roku, we can see that this graph looks a lot like the graph of ARK Invest, doesn't it? Big spike in 2020, 2021, and then it just comes falling down to earth. So what's going on with Roku? Let's look at their financials. Now, this looks a little different because Roku is growing 19% year-over-year revenue growth. Okay, so we have a little bit of a different story as opposed to Unity and Teladoc. Now, Roku is still making a loss, but that loss has shrunk in the past couple quarters. All right, so far I'm not hating what I'm seeing. Let's look at the balance sheet for Roku. They have $2 billion in cash, which is really nice. Maybe they can make some strategic acquisitions. Maybe they can start to buy back their shares at these cheaper prices. Maybe they can invest in the business. There's a lot that can be done with Roku's cash pile. Okay, so far out of the three stocks we looked at, Roku is looking the most promising. Let's dig into Roku a little bit. So what I'm doing here is trying to figure out why the stock is down, even though their revenue growth is still continuing, and even though they have a pretty nice balance sheet. And I think I found a key metric that is pointing to some of this underperformance. Average revenue per user, or ARPU, was $40.65 which is flat year over year. Okay, so even though the revenue is growing, they're not able to grow their revenues per user anymore. Now, this is really important because at a certain point, everybody is going to have a Roku streaming device that wants one. They're not very expensive. It's not something people have to save up for. So if you have a quote unquote dumb TV and you want to turn it into a smart TV, you've probably already bought a Roku system. So if Roku can't land and expand or milk more money out of their current customers, they're not going to be able to capture money from new customers because there just aren't that many new customers left. That's one of the traps you can fall into. For me, when I was looking at their revenue growth, I saw that they had 19% year-over-year revenue growth. However, that's looking backwards at the company. We need to look forwards and see what's going on in the future. And if they're not able to grow their average revenue per user, I don't think that revenue growth is going to continue. And they, like I said, they still have not turned a profit. So I believe they're going to see the same situation that Unity and Teladoc have seen. Now, this is really upsetting because these are innovative companies that at one point were growing really, really rapidly and capturing market share. However, what you need to do is look past that and have a plan. So after you finish capturing market share, you need to quickly turn a profit to reward investors who are along for the ride, who saw this massive revenue growth. Because revenue growth means nothing if you never turn a profit, right? It doesn't matter if you're not profitable now, but you need to be profitable someday, and there needs to be a path to profitability. And I'm just not seeing it with Roku, Teladoc, or Unity. So let's go back to the original question. Is ARK ever going to recover? I don't know. So ARK saw a lot of success in 2020 because all of the stocks that they invested in were growing really rapidly and we're seeing lots of adoption. But when we look at the list of companies they're invested in now, Roku likely no longer to be growing, Square growing a little bit, Roblox growing but not turning a profit, CRISPR Therapeutics, highly speculative, UiPath growing single digits, Zoom growing single digits, Palantir still growing, but maybe the valuation's too high. What does ARK need to do? If I was managing ARK, what would I do? Well, I think the main thing is risk management. I don't think Cathie pays enough attention to risk management. She's investing in so many unprofitable companies. And I get that that's the point. It's disruptive innovation. But when these unprofitable companies are no longer growing, can we really call them disruptive innovation anymore? I see some stocks here that are growing nicely that are profitable. It's Palantir. Shopify is not currently profitable, but they have been profitable in the past. We see some companies that are high quality. The Trade Desk. Meta. I mean, I don't love Meta as a company, but you can't deny that it is a good stock. So what I would do if I was Cathie Wood is focus more on these companies that are still disruptive, but a little bit less risk. There's no need to go around digging in the garbage when there's great companies just sitting here right in front of her face. So I'm not saying that these companies are garbage, but I'm just saying that things look really bleak. And I think if ARK Invest had managed their risk a little bit better, they wouldn't be in the situation they're in today. Now, they might not have seen the massive growth that they saw in 2020. So it's a bit of a double-edged sword. And at the end of the day, this is a disruptive innovation ETF. So the goal is to find companies that are yet to be proven and may turn into the next big winner. So anyway, that's a bit of my rant on ARK Invest. Just to summarize, Unity and Teladoc I used to own, but I have sold. Roku I've never owned, and even though the revenue growth is compelling, I don't see it continuing, so I'm not looking to open a position in that today. ARK Innovation ETF, I don't hold ETFs personally, but it's not something I would look to get into because they really need to work on their risk management so that they can show investors that they can deliver strong returns and provide a good Sharpe ratio. So Sharpe ratio is simply your risk to reward. So a high Sharpe ratio means you took on less risk and got more reward. With ARK, you took on more risk and got less reward. It's just not good. Anyway, thank you guys for watching today. I hope you enjoyed the video, a little bit different than most of my videos. When the weekends roll around, I like to do things that are just a bit different. So if you liked this video, please hit the like button. If you're new to the channel, please subscribe. And if you didn't like this video, hit the dislike button and tell me what you didn't like about it so that I can improve in the future. Thank you guys so much for watching, and I hope you all have an awesome day.